welcome. In this video, we will look at using put options for speculation. In the last video, we looked at an example of using a put option as an insurance policy to protect against loss on a stock the trader already owned. In the example, the trader owned 100 shares of SLV, the silver ETF. He was bullish long term, so he didn't want to sell his shares of SLV, but he was concerned that SLV could drop in price in the near future for some reason. Therefore, he bought a put option to lock in a preset sell price in case SLV dropped in price. That was an example of a trader using a put option as an insurance policy to protect stock that he already owns. A put option could also be used as a speculative instrument. Let's take the same scenario with another trader using a put option for speculation. At the time of making this video, SLV is $18.62 a share. The trader does not own any SLV. However, he feels that SLV will definitely drop in the near future. He could short sell 100 shares of the ETF, but instead he buys an $18 put option for 33 cents per share. The trader has now locked in the right to sell 100 shares of SLV for the price of $18 per share anytime between the time he buys the contract and the time the contract expires. If SLV drops below $18 per share, he can buy SLV and immediately sell it for $18 anytime until the option expires. Let's say that SLV drops to $17 per share. The trader can buy 100 shares for $17 per share and use his option contract to sell SLV for $18 per share. He paid $17 per share, plus the option contract cost him 33 cents per share to buy. So his total cost was $17.33 per share. But he had locked in the right to sell SLV for $18 per share. He sells SLV for $18 and he paid a total of $17.33 per share, so he makes 67 cents a share minus brokerage commissions. The trader paid 33 cents per share to lock in a sell price of $18 per share. Therefore, for the trader to make money, the price of SLV must be lower than $17.67 per share. In other words, SLV must drop at least 33 cents per share below the locked-in sell price of $18 to pay for the 33 cents per share cost of the option. Locking in a sell price of $18 per share for a cost of 33 cents per share means that SLV must drop to $17.67 per share or below. If SLV does not drop below $17.67 a share, the trader loses money. If SLV stays at or above $18 a share, the trader would not choose to use his option to sell the stock at $18 per share, since he can get more for selling it at the current price at the time of more than $18 per share. Therefore, the option expires worthless, and the trader loses the 33 cents he paid up front. If SLV drops below $18 per share, but not below $17.67 per share, the trader does use his option. He buys SLV at the current price of between $17.67 and $18 and sells it for $18, making the difference between the two. However, the amount he makes is less than the 33 cents upfront cost he paid, so he loses some money, but not the whole 33 cents a share he would lose if SLV was at $18 or higher. Now let's compare shorting a stock versus buying a put option. Shorting a stock requires more capital up front. Buying the $18 put option only costs the trader $33 up front. If the trader shorts the stock and the stock rises in price, his losses are potentially unlimited as the stock can climb to any price. But by buying a put option instead, his possible losses are capped to a maximum fixed amount of 33 cents per share or $33 total plus commissions. Even if the trader shorts SLV and uses a stop loss to protect his account to a maximum loss, the price of SLV could gap overnight or over the weekend, causing him to lose more than anticipated. The possible losses on buying an SLV put option is capped to a fixed amount. If SLV does drop in price, the potential percent gain is much greater with an option. Let's say that SLV drops to $17 per share. The profit on an option trade is a much larger percentage of the required money up front. There are two trade-offs here. The first is that SLV must move a certain amount for the option to become profitable. So SLV could drop in price only a little bit, causing the trader that shorted SLV to be profitable, but not enough that the put option is profitable. The other trade-off is the time factor. Whereas the trader that bought the put option has a much larger potential gain and a capped maximum loss, his contract has a 1-month time limit. In this example, the trader chose an $18 put option on SLV when the current price of SLV was $18.62 a share. This was not his only choice of contracts to buy. In the next video, we will look at other contract choices the trader could choose, with emphasis on the relationship between the upfront cost of the options, also known as the premium, the preset sell price that is locked in, also known as the option strike price, the potential gain, the potential loss, and where the price of SLV has to be in each situation for the trader to be profitable. See you then.